Hey friends, Alex here. Are you curious about how real estate can make you money, but find all the jargon confusing? In this video, I'm going to break down the essential language and concepts you need to know to start your real estate journey, and I'll show you how understanding these basics could help you generate income and build long-term wealth. Stick around, because by the end, you'll know how to start looking at real estate like a pro, even if you're just starting out. Alright, so here's the deal. Real estate has its own language. If you're just diving in, words like equity, mortgage, and cash flow might seem overwhelming, but they're actually pretty straightforward once you know what they mean. Today, I'll give you a crash course in these terms, so you don't just feel more confident, you feel ready to take action. Let's start with a term we all know, home. Now, in real estate, home has a lot of variations, and understanding these can help you choose the right type of property. First, we have what's called a single-family home, or SFH. You'll often see this abbreviation in listings, and it means a standalone house meant for one family. These are the bread and butter for a lot of real estate investors, including myself, because they're simple and in high demand. If a property is divided into two units with separate entrances, that's a duplex. It's like two homes in one, which means you can rent out both sides for double the potential income. And if you see a property with multiple units, that's usually multifamily or apartment complex real estate. These properties have more doors and often more cash flow potential, but they also require more management. I'm a big fan of single-family homes because they're easier to manage and can still generate significant cash flow if done right. Now let's talk about equity and mortgages, two words you're going to hear over and over in real estate. Let's say you're eyeing a home that costs $200,000. Most people don't have $200,000 sitting in the bank, so they get a mortgage. Think of a mortgage as a loan specifically for buying property. When you get a mortgage, the bank typically requires you to put down some cash up front. This is called your down payment. If you put down 10%, that's $20,000, which means the bank covers the rest, or $180,000. This $180,000 is your mortgage loan balance. Here's where equity comes in. Equity is the difference between what the property is worth and what you owe on it. If that $200,000 house appreciates and is now worth $250,000, while you still owe $180,000, you've gained $70,000 in equity. Equity is essentially your wealth growing as the property's value grows. And it's a powerful concept in real estate because over time, you can use it to buy even more properties. You follow? Drop a "got it" in the comments if this is making sense. Let's move on to cash flow. Cash flow is what you pocket every month after covering all expenses, including that mortgage payment. Imagine your mortgage payment on this property is $800 a month, and you're renting it out for $1,000. After subtracting expenses, let's say you have $150 left over. That's cash flow, and for a lot of investors, this is the holy grail. If you can get properties that generate steady cash flow, you're setting up a nice stream of passive income. Cash flow can make real estate a steady and reliable source of income, even if it's just a few $100s at first. Over time, as you add more properties or raise rents, that cash flow grows. It's a powerful way to build financial security. Quick question for you guys. Would you be more interested in cash flow or equity? Drop your answer below. Now here's a tip that a lot of people overlook. When you make a mortgage payment, it's not just paying off the loan. There's something called PITI, which stands for principal, interest, taxes, and insurance. Principal is the amount that actually goes toward paying down your loan. Interest is what you pay the bank for lending you the money. Taxes are property taxes, which the bank may include in your payment to make sure you don't fall behind. Insurance protects the property in case of damage, and banks require it to protect their investment. This is important because it affects your cash flow. If you're looking at potential properties, make sure you're factoring in the full PITI when calculating expenses. It's one of the easiest ways to make sure your numbers add up before you make a purchase. Let's talk about a simple but powerful principle. Buy low, sell high. This is how you build wealth in real estate. You make money when you buy a property below its actual market value, or when it's undervalued and can be improved. For instance, let's say you buy that $200,000 home at a great price, maybe $170,000 because it needs some minor updates. If you put in a few $1,000s worth of upgrades, you might be able to sell it for $230,000 or rent it out at a higher rate. That difference is your profit, or increased cash flow. In real estate, buying right is half the battle. If you're interested in hearing more about how to spot a good deal, let me know in the comments, and I'll make a video on that. There are a few more terms you'll hear in real estate that are good to know. Here's a quick rundown. Appreciation. This is when a property's value goes up over time. A big benefit of real estate is that, historically, property values tend to appreciate. Depreciation. This is actually a tax term that lets you write off the wear and tear on your property over time. It's a big tax advantage in real estate. Leverage. Leverage is using borrowed money to increase your investment potential. In real estate, leverage is huge because it lets you buy properties with a small down payment, controlling a large asset with little cash. With leverage, you get to own the property and benefit from its growth while paying the bank back over time. It's how most people can afford to invest in real estate, and it's a strategy that can accelerate your wealth if done carefully. So there you have it, the core concepts of real estate, broken down. If you master these basics, you're already ahead of the game. You know what type of property to look for, how to understand the mortgage, calculate cash flow, and leverage appreciation and equity for long-term gains. I'd love to know what you thought of these tips, and if there's anything you want me to dive deeper into, let me know in the comments. If you're ready to start building wealth through real estate, make sure to hit that subscribe button and share this video with anyone else who might want to learn. And remember, the more you learn, the more you earn. Thanks for watching, and see you in the next video.